bonds. I'm going to try to wrap this up in 2 or 3 minutes, and we'll do some Q&A. So staying in their lane, we still think there's absolutely a place for bonds in a portfolio. I like to say like this: sometimes bonds help you stay in your stocks. What do I mean by that? You got some stocks, you got some bonds, maybe a little bit of cash, whatever. If the market gets killed like it did last March when your stocks are down 30, 40%, whatever it was, depending where you were, what'd your bonds do? Bonds probably did pretty well, right? They helped you stay in stocks. Stocks are the best way to create wealth over the long term. So bonds do their job, and bonds can give you some wealth too. Don't get me wrong there. But I think that's why it makes sense. But again, how are we constructing our portfolio started this year? We have more stocks relative to bonds. Fortunately, that's really, really worked out the first 6 months of this year, and we think it can continue. But that's kind of where we think bonds are staying in their lane. The 10-year yield has been going higher. Now, it's surprisingly been going lower a little bit lately. We still think interest rates go higher, tightening labor force, pushing up inflationary pressures. And just keep it simple. Rates go up, bond prices go down. Bonds had one of their worst first quarters ever, all right, in the first quarter of this year because rates went up so much. And we think the 10-year yield can continue to kind of work its way higher the rest of this year, which could pressure bonds. We think bonds might be about flat the rest of this year, which isn't the end of the world. Believe me, that's not a terrible thing. But we still think this is more opportunity as it pertains to stocks. Almost done, I swear. Peter Bernstein, diversification is the only rational deployment of our ignorance. I'm a big Peter fan, read a lot of his books. He's saying, let's not outsmart ourselves. Stay diversified. Have some bonds, have some cash, have some stocks, maybe gold. Talk to your advisor, whatever. I mean, there's different things you can invest in a proper portfolio globally. I mentioned international, Europe, Japan. Those are looking a little bit better. There's some other areas you can invest in. So stay diversified to help with our ignorance. I love how Peter says it. And this is just a cool way of showing it. A lot of numbers on here. Look where it says return on the right there. We have big pullbacks in stocks, the S&P 500. Look at Barclays Ag. That's your average bond fund. Bonds usually do pretty good. Treasuries, long-term treasury, that should do really good. Safest instrument there is out there almost. So that's why it makes sense to still have some fixed income exposure. We just think rates keep going a little bit higher early in economic cycle. Stocks will probably do better. And if you want to get real geeky with some of this stuff, if you keep having higher trending 10-year yield, we think 10-year yield can go up between 1.75 and 2% by end of this year. If that happens, something like mortgage-backed securities can do really well when yields go higher. Also, bank loans and bank notes, those can kind of hang in there and do a little bit better on the fixed income side of things. So I think we probably are about done here.